Hello and welcome to our True Options Masters monthly market outlook for January 2022, start of the year. We have in the room our two maestros, Mike Carr and Chad Shoup, and today they're going to talk to you about what we see for the month ahead. But before we do that, we just kind of want to start on a little bit of a bigger picture. You know, guys, I feel like we're coming out of 2 years that could not be any more different. You know, 2020 was a year of, very good for technology and innovation stocks. The smaller the stock, the better. And then 2021 was almost a complete reversal of that. S&P 500 up 27% last year, actually beat the NASDAQ. And I think went up by one of its widest margins in a couple of decades. So maybe we just need to start there, guys, and just talk about some maybe general stuff that we see for the year ahead. I know that it is very hard to make predictions more than a few months out. You know, as options traders, we typically select expirations that expire in 2, 3, maybe 4 months. So it's kind of hard to predict what's going to go after that. But maybe we just need to start and talk about the lay of the land a little bit. You know, we've obviously are entering in a changing interest rates environments. And I don't know how you guys think that might affect certain stocks and certain sectors. So I don't know which one of you guys want to pick it up, but I'll throw it to one of you guys.
All right, I don't mind jumping in because I know how Mike feels about predictions. So I'll get mine out of the way before he talks. But when I read my prediction article, when I look at what's going to happen here in 2022, I'm hoping that the conversation shifts from the virus and the pandemic and all these supply shortages and all that into interest rates. So hopefully all that starts to work itself out here in 2022. Now the Federal Reserve is supposed to hike interest rates 3 times this year. That's the expectations. And a lot of times whenever interest rates are going up, people get nervous because all the headlines, the reason they're hiking interest rates is to cool the economy. And a lot of the initial reactions in the stock market will be a little dip, just a few percent lower. But my whole point is that you don't have to get worried about when the Fed starts to raise interest rates. It's not always a bad sign for the stock market. And I don't have the chart with me today, but I had the chart that I put in the article that just aligned the previous interest rate hike cycles with the S&P 500. And you can see that you still have years of a bull market, even as they're raising rates. Even when they stop raising rates, a lot of times you still have another year or so to where the market can continue to run hot. So it doesn't mean that the bull market's over. In fact, it means that 2022 is likely to be a pretty good year for the stock market. Once again, the S&P 500 probably won't top the 27% that it did last year. That could be a stretch, but I'm looking for small caps to outperform this year compared to last year, since they did take a breather after the big move in 2020. They took a breather in 2021. So now I'm expecting small caps to take off again here in 2022.
Well, that's music to my ears, Chad. My portfolio is mostly full of small caps because I'm a little younger and I've got the time for them to mature. But last year was a little bit rough in my portfolio. So that's certainly music to my ears. Mike, what do you think?
Yeah, I agree with everything Chad said. The Fed said they're going to raise interest rates 3 times, and that'll put the short-term rate all the way up to 0.75%. Still near a 5,000-year low. So this is nothing to get excited about. And the Fed is not raising rates to cool the economy this time. The Fed is raising rates so that they could cut them when next time we go into a recession. They're just in a panic mode. They need that symbolism of the 1/4 point cut next time we hit a recession. So definitely nothing to get excited about on the interest rate Fed side just yet. Plus, the bull market's not even 2 years old yet. Remember, this bull market started in March 2020. This doesn't date back all the way to 2009 like a lot of people want to date it to, because we had that 30% decline, 35% decline in March 2020. So the average bull market lasts about 4 years. We are in year 1 3/4 right now. We got a long ways to go. So I'm optimistic like Chad is.
Definitely love the optimism. So let me ask you guys a question. So with inflation up, I don't even know, what was it? CPI hit, what, 6, 7 or something like that by the end of the year? I think that's what it's what?
6.9.
6.9, there we go. So now, Mike, you're saying quarter point hikes. Now, the Fed's not necessarily limited to just doing a quarter point each time. Do you think that they could do it more based on what inflation is doing?
They absolutely could. They have in the past done 2-point hikes. That's way in the past. That's before you were even born, Chris. Excuse me. They're not going to. That would set off a panic in the stock market. And Powell is very concerned about keeping the stock market steady. So no matter what he says, we need to watch what he does. And I have some charts that'll show what we need to watch. And by watching that, we're just not seeing any sign at all that the Fed is pulling back on the money supply. Now, I want to go with a long-term forecast, actually a historical analogy. I think we're like the early 1900s. So the 1890s, we had the Gilded Age, which was when the industrialists became the bad guys. They built huge steel companies, railroad companies, oil companies, and then regulators went after them. Well, that's where we are now. We had companies built on technology. We had Amazon, Google, Facebook. These are the equivalent of the railroads, steel companies from the 1890s. More importantly, in the economy, there was a huge debate about monetary policy. And this was 1896 with William Jennings Bryan Cross a Gold speech, where he was for easy money. He lost that election, but we still had easy money in the early 1900s, despite his loss. So I think that's where we are now. We're seeing easy money, interest rates not as important, because remember, there was no Federal Reserve, there was no interest rate policy back in the 1900s. Stocks were volatile, but generally bullish, except for some crashes in 1907 and 1909. So I think that's a better analogy than recent history, because recent history is unprecedented.
Right. Well, both gentlemen have referred to their predictions articles for this year. We'll include links to both of those in the description box below. So with that, Mike, maybe we'll go ahead and turn it over to you, let you share your screen. You were talking about some charts that you wanted to show that illustrate some of the things you've been talking about.
I want to start with a simple chart of the S&P 500. I have been pointing out the importance of the 50-day moving average. We saw it come into play in the December sell-off. If you had sold everything but the cross below the 50-day, which isn't the right thing to do, it's time to get cautious, you would have had the signal to get aggressive again. Days later, really a wash. And that's what we're seeing. The 50-day has been protective, but you're not missing out on anything by taking those signals. So still worth watching. Longer term, this is an uptrend. Here's the beginning of that bull market, very clear uptrend here. But what I find interesting, I've highlighted one of the patterns. We see the uptrend, consolidation, and then a move to the next target. And for the next target, all I'm doing is taking the depth of the consolidation and projecting higher. And the most recent one gives us a target right where we are now. So this recent consolidation from September, October told us to expect to get to where we are now. That should then form a nice support level for us. So we should have support near the current level. And we're targeting about a 4% move from here. So we should see about a 4% rally in the S&P before the next consolidation. And that could be January. IWM, I wanted to take a similar approach, but a longer term look. There's that 50-day moving average. That's a trading range that I highlighted last month. I have not updated this chart. The price action came down right to the lower bound of that trading range that we highlighted in December, rallied off of it right to that red line, which was drawn a month ago. And we're consolidating near there now. We are set up for a break above that 50-day and then a rally up to the top of that range. That's also 4%, and that's also likely to happen in January. This is the Fed chart that, I'm always going to show a Fed related chart. And the green bars highlight times when banks are building up cash. So this is your local bank is increasing its cash reserves, cash balances, and that means it's not lending as much as it can. So it's kind of stockpiling so it can lend in the future. The stockpiling has been going on for a long time now, since July 2020. What we see in the past, after the stockpiling ends, the stock market shoots up because banks are lending. And as banks draw down their reserves, as banks lend that money, it goes to Main Street businesses, which just boosts the economy. So banks are sitting on cash now. Once they release that, we're going to see the economy accelerate, and that'll lead to an acceleration in the S&P 500. And then the final chart is that indicator. This is the amount of Treasury securities that banks are holding right now. And as you see, strong uptrend. So even though the Fed is making noise about we're going to tighten, we're going to stop QE, we're going to raise interest rates, that's what they say. This is what they're doing. There's still a lot of money flowing into the economy, strong uptrend here. We should expect the strong uptrend in stocks to continue. Back to you, Chris.
Mike, can you go back to your IWM chart? So this is kind of what we were talking about. 2020 was just a monstrous year for it, and then just nothing but consolidation in 2021. You can't really tell it from this chart, but within the small cap market, there have been stocks that have gone down 50 to 80%. I know because I own quite a few of them.
Right.
Now, let me ask you a question. So, Chad said earlier that maybe we won't see 27% in the S&P 500 this year. IWM may do a little bit better. But Mike, what you're saying to me suggests that, okay, maybe not 27%, but maybe we still see another, above average year for the S&P 500. So let me ask you a question. Can the Russell 2000 and the S&P 500 both go up at once? And I know it may sound like a simple question, but I think that they have completely different risk appetites. When people are feeling a little more cautious, they invest in larger cap stocks. When they feel more aggressive, more speculative, they'll invest in small caps. So what do you think?
So this is that same chart that I showed of the S&P bank stockpiling reserves. And then when they release the reserves, as we see, small caps also shoot higher. And right now, the banks are stockpiling reserves. When they release that, they're going to lend money to those small caps. And the small caps right now are kind of starved for capital. They're uncertain as to whether they should invest. Remember, small caps don't go to the bond market as often as they go to banks. So when that capital flows to them, you're going to see just a surge higher in small caps. I think you're going to see more than 20% in the Russell this year. And I'm not absolutely certain, but I think you're going to see more than 20% in the S&P again this year.
Gotcha. It makes sense. If banks are going to be lending to, mainstream Americans, obviously small cap stocks, we're talking, $1 billion companies in some cases. They're not teeny tiny, but they're certainly probably going to benefit from it more than, say, multinational, multi-billion dollar conglomerates that actually have probably the cash on hand as it is. So that makes sense. Okay, Mike, I think that's all I had for you.
Okay, I'll turn the screen over to Chad.
All right, thanks, Mike. That's a lot of good stuff. I like all the short-term bullishness, getting away from our year-long predictions and looking at the month of January. Let me pull up my Optima platform. So I always talk about the relative rotation graph, like I call my profit radar, and how we look at these sectors on a month-to-month basis. So quick recap of last month. So this is the energy sector. That was the sector that we wanted to put on our radar. And this was back on December 1st. So that was when we sent out the video. And since then, it went up a little bit, mostly sideways, a nice dip. And then the big move higher on Monday helped us look a little bit more bullish than it was. But once we got into the stocks that we recommended, here's Transocean. This was rigged. This one went sideways, almost completely flat over that time period. So it didn't do what we were expecting, which is to run higher. But when we get into NOV, National Oil Varco, from December 1st, it was up about 20%, counting the Monday move. So it was a big jump from here, which is when our video went out, coming out of that lagging quadrant, and then into the improving, which is blue, and then leading is green. So it's the exact rotation that we're trying to play when we jump into these stocks at the point that we do. So this one played out nice, 20% run. And then Halliburton, this one also was up double digits. Big move on Monday, up another 6% today. It's up to $25, above $25 last time I checked. And this is Tuesday that we're taking a look at this. So on Tuesday, it ran up 6%. So a nice run for Halliburton too. So there's two out of the three stocks that we looked at. We're on a nice move higher for the month of December. Now in January, we'll go back to our profit radar as a whole to take a look at the sectors that we want to look at, and just keep in mind that these are looking at the S&P 500 sectors relative to, and I have a few other things in here like gold and IWM, because they're all relative to the S&P 500. So we're looking at the 10 sectors, gold, IWM, biotech, a few other things, all on how they're rotating around the performance of the S&P 500 to figure out if they're lagging down here in the red, and look for this rotation from lagging to improving and then leading. That's kind of the sweet spot that we want to catch. And right now, the sector that's making another move again is energy. And this is just, this is like what, our fourth month talking about energy, it seems like. And it's not that this is the only sector that's making this rotation. It's just that at the time of the month that we do these videos and we take a look at where they're at, energy just happens to keep kind of making this rotation back into the picture that we want it to be bullish.
And where was it a month ago, Chad?
So we go back to that December 1st, rewind. So here's December 2nd. But that's kind of starting to make that same turn there on the 2nd. So it's still down here, starting to turn higher on the energy sector. And that's what we were trying to catch. So now fast forward to today, though, we're going to talk about an energy, but I also want to bring up tech stocks, because even though they didn't get deep into the lagging, they dipped into the lagging briefly, then back into weakening. So this is even a shorter rotation pattern, but it means that tech stocks are likely to be strong here in the month of January. So I want to just give you a couple stocks out of the tech sector, a couple stocks out of the energy sector to keep an eye on here this month. And before we jump into those stocks, though, just look at the energy sector, the performance that it had when it moved higher on Monday. It broke out of this kind of downward trend pattern that it was creating, had to break out of that. So now we're just expecting that to hold and then continue to push higher in January. And then the other thing that I wanted to highlight is that back before we had energy on our radar was during this, when it was in lagging, and then we had it on our radar then, and then it went back to lagging. So it's kind of a double dip into the lagging quadrant where it doesn't really get that full push into the leading and go through this whole cycle. And then all of a sudden it broke out into leading and we saw the big move higher. So now we're seeing the same thing again. It's kind of holding higher, didn't see a big drop, but it went to the lag, weakening is yellow, then lagging, then an improving quadrant. This was from last month, but then it dipped back down into lagging, and now we're back into improving. So it's going back through that cycle again. And since it broke out of the resistance kind of channel that you can see on the chart, I'm expecting it to be strong here in January. So a couple stocks that you can keep on your radar. Energy, these are pretty easy. I had them pulled up right here. I can zoom out just so you can see the rotations and how everything's kind of whipping around and where everything else is. But the three stocks that are just at the perfect point to jump into are OKE, Murphy Oil, and HES, HES. So these are the three energy stocks. They're kind of making that turn higher, heading to the northeast, out of the lagging quadrant. And now we're looking for them to head into improving and then eventually leading the market. And once we dive into the stock part, I just keep in mind, we're always looking at these relative to the underlying sector. So this is based on the energy sector and how those stocks are rotating through. So we're expecting
Halliburton and NOV right now, Chad.
Halliburton, and NOV. Where did they go off to? So NOV's
Okay, wow.
way over here. So it made a big run up. I can expand it back. But you see NOV made that big run. Then Halliburton is down here. So it was more choppy, but it actually came from all the way up here.
Well, it's very interesting where they are because they're obviously still in the leading quadrant, but they are in the very, very southern part of it, pointing down.
Yeah, so they still may go up. You know, if the whole concept of this is kind of a rising tide lifts all boats. So as the energy sector moves higher, it's going to carry these stocks higher. So, but we're trying to find the ones that are going to perform the best, and that's why we kind of come over here to the ones that have been underperforming and are expected to make the biggest moves to the upside. So these are starting to weaken. They still could move higher, but they probably won't outperform the energy sector as a whole, or at least some of these stocks that we're getting into over here on this side. So the three to keep an eye on this week or this month: OKE, Murphy Oil, and Hess. And then to the tech sector, they had a lot of stocks that were already kind of leading the market. They already jumped and were kind of making this move over here. And then a couple that were just a little behind. You see NVIDIA, this has already been making that rotation up higher. Same with Xilinx, kind of been in this move here for a week or two. So we're a little behind the curve on those. So the stock that I like is Adobe, because it's just now starting to make this turn higher. And it's a more volatile stock. You can see on the chart that it's seeing some big moves here. And we're just expecting to get a bounce out of this based on tech stocks starting to outperform and Adobe being an underperformer sets a snapback. But then the other stock that we'll look at is going to be a little bit stronger. That's Analog Devices, ADI. And this chart is a nice uptrend. So it's just riding the trend higher. We're just looking for this bullish momentum to carry it even higher, get back to the top of this price channel here over the next few weeks. So those are the two stocks, and just two out of the tech sector today, just because of where the other ones are at. Texas Instruments, you could take a look at, but Qualcomm is actually setting up in a nice spot. But I don't really recommend it because, well, it has earnings on February 2nd. So it had the big breakout, and now it's basically consolidating. And it could be stuck in this consolidation for another month, though, until we get to February 2nd, which is when they have earnings. And that'll probably tilt the scales either up or down for the stock. And I'm still bullish on the stock, but that's getting into February. So maybe that's something we could talk about next month. But that's all I had for today. Just energy sector, tech sector to watch for outperformance in January, and three stocks out of the energy sector: OKE, Murphy Oil, Hess. And then out of the tech sector, we have Adobe and ADI.
Yeah, and Qualcomm's a little bit too close to the center anyway. That typically means it's probably not going to be as volatile enough to really rocket it higher.
Yeah, I won't see the biggest move. So yeah, it's a good one to pass.
Gotcha. All righty. Thank you, Chad. Well, Chad, I do love those videos. Obviously, we saw it work out with NOV and Halliburton last month. So we'll be excited to see what we see from these energy and tech stocks, a month from now when we do this again in February. But I appreciate this one, guys. There's a lot of uncertainty in the market, with interest rates and inflation, all that stuff. But I appreciate the optimism. You guys just saying, like, don't worry about it, stick to your guns. And I definitely like the sound of seeing big moves in both large caps this year. But to all our viewers, just keep watching these videos, keep tuning into our articles every weekday at 11 o'clock. Please subscribe to our YouTube channel if you haven't. If you're enjoying this content, please like, comment, and share on your social media platforms so we can get this out to more people. So with that said, gentlemen, thank you again for your time. And to our readers, we'll talk to you later.